I'm really excited, obviously, to be able to speak about climate finance and the importance of the financial sector in meeting our climate and environmental goals. I think that it's not ever fair to say that only one sector makes a difference, and it's not fair to say that any single institution can do these things alone when we're talking about global challenges and global goals. And yet at the same time, the financial sector does play a unique and powerful role in bringing together various actors within the real economy, both through providing investment funding, providing underwriting and insurance, providing capital through lending and bond issuance. The point being that there's a huge amount of ways in which the financial system is the fuel, is the lifeblood of the producers, of the industries, of the transportation and manufacturers that are producing emissions, that are leading to the continued warming of our climate. And on the other side, on the physical side, also finance is the thing that is necessary to facilitate the construction of adaptation, the building of both climate resilient communities, as well as secure and safe countries from the effects of climate change. And so recognizing that the financial system has a role both in supporting the current production of emissions, as well as, of course, the whole economy itself, but also abilities to adapt and to mitigate climate's impacts through funding of green energy, through funding of green innovation and technologies, really means that it sits at a very pivotal position within the overall economy, and there's a lot of leverage there. And as a result, as we move ahead, looking at the coming months, we have, of course, the Conference of Parties in Glasgow, and that Conference of Parties is going to be a particularly important one for the financial sector as well, because of the work that is coming together to say, if financial institutions aren't going to commit to net zero, then we're not going to be able to reach net zero as a society. So as these commitments are getting made to decarbonization and to net zero, how do we put them in practice? And what is the policy environment that is necessary to accelerate those commitments? But also, what role can finance play in accelerating those commitments? I think one of the big mistakes is often assuming, well, this kind of decarbonization could happen, but only with government action. As I said at the beginning, there's no one sector, there's no one lever that works in isolation. It's only when we talk together about how these pieces fit together do we see action. And so it's not enough for institutions to wait around and say, we will be net zero when the policies exist that make net zero economical, but rather they need to be the pushers and the advocates for governmental policies around net zero, for setting their own higher standards of expectations around decarbonization, for setting their own green funding and financing targets to promote adaptation and efforts to alleviate the worst effects of climate change. These are the real imperatives that the financial sector faces, not just to manage and measure risks, but really to take an active role in the decarbonization of our society. And when we think about that, a great example from industry of this dynamic going on is really what the various disclosure standards have done. And if we think about that, probably the TCFD is the best known of them, most widely used. This is the Task Force on Climate-Related Financial Disclosures. That TCFD is one that is particularly focused on climate risks as well as climate opportunities. And yet this year, what we saw the TCFD do was release a consultation, soon to be finalized in the next couple of weeks, that talks also about transition planning. And why transition planning? Because as I said, it's particularly necessary not just for financial institutions to assure that they are managing their risks effectively, but also to ensure that they are effectively dealing with the challenges that they're confronted with as they move toward net zero And so if they're not actively moving on that road, even if they are managing their own individual risks, they're not doing enough. And I think while that is true of individual companies and individual financial institutions, it's even more true of the whole sector, that this whole sector is one that not only requires the passive elimination of funding for emitting activities, but the active support for adaptation, the active support for accelerating and mitigating the challenges of climate change. And so that's really where I would start my remarks. What I would say, looking at this global environment and kind of asking, what are each of these areas? What are the ways in which the financial sector can contribute and can play a positive role? I think the first is in accelerating decarbonization. And doing that is not just a matter of divestment alone, but also active engagement and responsible retirement of emitting assets. So we can't just walk away from a coal plant, but we need to think about, what does it mean? How do we close it as quickly as possible in a way that is environmentally responsible? We don't leave open pit mines. We don't stop various activities when there's still potentially a danger. We have to have wind down and elimination plans. Financial institutions can play a role in helping companies to come up with those plans, but they also can play a role in saying to companies that funding and financing is contingent on them meeting their own climate goals. And so if you've committed to net zero as a bank or an investor or an asset manager, then you are going to need to be working with clients and portfolio companies that they themselves have also made similar commitments. And you're going to need to be able to track and follow those commitments. So I think the financial sector has an important role to play in pushing the real economy and adding pressure to that real economy to act, and to act in an assertive manner to decarbonize. And also in that way, give the market reasons and the market incentives that make decarbonization more economically profitable than continued emissions. And so while there are always going to be companies in the real economy working on these topics of decarbonization, the financial sector really has the ability to play the role of an accelerator, to really pick up the speed and to drive faster and to drive more effectively into a decarbonized society of the future. So that's one way to think about the role of the financial sector. But when we get down to it, we talk about this question of engagement. What does it actually mean to engage with the real economy? What are the things that the financial sector needs to be doing specifically? If this is something that will be helpful to limit emissions, what does engagement look like? At the very simplest level, as I mentioned, divestment is one option. And I think divestment always needs to be on the table. It may not be the most desirable option. It may not always be the most effective option, depending on the circumstances. But without a serious promise and pledge that if a company does not commit to greening its activities, then a financial institution is willing to walk away from that opportunity. Without that, then any other sorts of claims lack credibility. They don't have the strength or the coherence to know that they're going to drive action. Because if the relationship will continue regardless of whether climate targets are met, then whatever engagement follows that is not going to be as effective. So even when we don't use divestment as a strategy, it needs to be an effective tool in the arsenal just to know that it's there. However, in many cases, and perhaps in most cases, it's not the best strategy, as I mentioned about the need for responsible retirement, but also engagement comes in the sense of voting for board of directors, whether also voting at annual general meetings, more on the investor side, on the bank side, looking at bank covenants. So what types of financing can be approved for what types of activities? Is this activity going toward further development and exploitation of natural resources? Or is it going toward a transition to a green economy? The same company, especially an energy company, can be working on both of those fronts and ensuring that the money is used and effectively deployed toward the green goal is one of the things that a financial institution can do. Another thing they can do is work to help standardize and structure the types of disclosures that are coming out from the from the real economy. I think this is one of the big challenges that companies face today, is that there's often not great data on their impacts and on the various future plans that they've set forth. The financial system can do a really important service in giving more clear guidance on what are the particular disclosures that are needed, what are the particular pieces of data that are objectively required for their assessments to determine whether these companies fit into their future strategy or do not fit. And if they do not fit, what are the types of special purpose funding as well as green products that can be used to help accelerate that transition and help move companies that aren't so green into a more green operating model. So those are a couple of the ways that the financial sector can and should interact with the real economy. One thing I haven't talked as much about is the relationship between regulators and government and public policy and the financial sector. And in many ways, there's an amplification effect. If the financial sector is beginning to move toward supporting decarbonization, that's going to have impacts on the cost of capital. It's going to have impacts on the desirability of certain assets in the future. And so as that process happens, there's a recognition that those things have ripple effects in the real economy. At the same time, that's not so different than what we see from the governmental sector, where activities like carbon taxes, restrictions on fracking, and other types of activities, these are all ways that government policy can shape the real economy. But the two operate in a feedback loop, that if the financial sector says, hey, we're not going to provide capital for this activity, or given the additional carbon tax or carbon credits generated from it, we are going to impact the pricing or quantity. You can see how the financial sector and government policy can be reinforcing toward climate goals. So financial institutions should be evaluating companies based on their potential resiliency to the policy shifts that are necessary for net zero. How will a company react and respond to a reduction in the overall price of fuels? But what about, on the other hand, how will it react to a carbon tax? How will it react to a supply crunch caused by restrictions on extraction? These are all questions that financial institutions should be thinking about in order to maintain both stable as well as sound portfolios. But in doing that and maintaining their own stable and sound portfolios, there's also support and recognition on the part of supervisors of the financial system that if financial institutions are not managing these risks well, not managing these challenges around decarbonization well, then it could present financial risk for the entire system and the wider economy. And so one thing that we've seen as an important development in the relationship between government and the financial sector on climate is a growing awareness from supervisors and regulators on the topics of climate change and on the topics specifically of climate disclosure. So the TCFD that I mentioned earlier has been increasingly required and mandated by a number of different institutions, from the European Central Bank to the Financial Conduct Authority in the UK, to the New Zealand regulator, with several more requiring climate disclosures in the future. And this speaks to the same issue that I mentioned on corporates. And that issue really is this notion and recognition that at the end of the day, companies need to be able to assess and need to be able to account for the work that is taking place and understand whether the companies that they've invested in, be those financial institutions or be those real economy actors, are actively and actually taking the steps toward decarbonization. So as I conclude my remarks, I would say a few things are particularly notable in the coming months with the Conference of the Parties coming up in Glasgow, which is first, that the financial system has taken on an important role and will continue to play one, but that role needs to become a lot more active and a lot more concrete. We have long-term goals that have been set and been set nicely by a number of the largest financial institutions in the world. But what we're still looking for are the short-term interim targets. If this is a journey of 10,000 miles, what is the first step? What are the things you're doing this year in the short term before 2050 to make sure that you get where you need to be by 2050? I think that's one of the biggest challenges that firms face, is actually operationalizing these things. It's one thing for your CEO to sign a commitment to net zero. It's another thing entirely to act effectively on that challenge. And I think the only way we get there, the only way that happens, is through a particularly effective movement toward short-term targets with real consequences behind those targets, whether it's that you might be removed from the alliances that you're part of if you don't meet those targets, whether it's that the government itself is mandating or expecting decarbonization targets each year. But ultimately, industry needs to find a way to decarbonize, and the financial sector needs to play a role in that decarbonization. So with that, why don't I conclude those my remarks and hand it back. I hope you have a great conversation and set of sessions today, and I'm very glad to be connected with